When people hear the word volatility, they usually think of instability or failure. Prices that move quickly are often seen as unpredictable or unreliable. Because of this, Bitcoin's price swings are often treated as a flaw, something that prevents it from functioning like traditional money. But volatility is not an accident in Bitcoin's system. It is not the result of poor management or temporary immaturity. Bitcoin is volatile because of how it is designed. To understand why, we need to step away from short-term price movements and look at Bitcoin as an economic system, how it is structured, how prices are formed, and how incentives interact within it. At its core, Bitcoin is a scarce digital asset with a fixed supply. There will never be more than a predetermined amount of Bitcoin in existence. Unlike traditional monetary systems, Bitcoin's supply does not respond to changes in demand. There is no mechanism to increase or decrease supply when conditions change. This means all price movement must come from demand alone. When demand increases, prices rise. When demand decreases, prices fall. Bitcoin also trades across many independent markets around the world. There is no single unified exchange that sets the price. Instead, prices adjust continuously as information, sentiment, and expectations move through the system. Another important difference is the absence of a central, stabilizing authority. There is no institution designed to smooth volatility or intervene during periods of stress. This is not an oversight, it is an intentional design choice. Bitcoin's behavior is also shaped by who participates in the system. Most people interacting with Bitcoin are not using it as everyday money. They are holding it, trading it, or speculating on its future role. This creates demand that is highly sensitive to expectations rather than current usage. Bitcoin also behaves like a young asset rather than a mature one. New asset classes typically experience higher volatility as markets discover value and liquidity develops. Volatility, in this context, reflects ongoing price discovery within a rigid, rule-based system. A common misconception is that volatility means Bitcoin is broken. In reality, volatility simply reflects how prices adjust when supply cannot respond. Many misunderstandings arise from comparing Bitcoin directly to modern fiat currencies. Fiat currencies are designed to be stable in everyday use. But this stability is achieved through active management, flexible supply, and institutional control. Bitcoin makes a different trade-off. It prioritizes predictable supply, decentralization, and transparent rules over short-term stability. Volatility is the cost of these choices. In simple terms, Bitcoin behaves less like traditional money and more like a scarce, emerging asset. Its volatility is not something to be engineered away. It is a natural outcome of how the system is designed. Understanding this distinction makes Bitcoin's behavior far less mysterious, even if prices themselves remain unpredictable.